Hello students, welcome to today's class. Today we are going to discuss chapter 8 of business studies. The name of the chapter is Sources of Business Finance. Up till now in the chapters that we have seen a variety of things. We've seen what businesses are, we've seen the different types of businesses, different kinds of businesses based on their ownership, based on the area they work on, based on the number of people, the liability, and we've seen several other things. We've seen the emerging kinds of businesses. So now when you reach to this chapter, you have a fair amount of idea what businesses mean and how do we basically form a business. By now, we've also seen that businesses are basically revolving around money or finance, right? So finance is required at all stages of a business, whether it is the stage of formation or it is the stage of regular running, or when they want to expand, grow and move on to diversify their own businesses. Whatever a business is doing, it does involve money in some form or the other. For carrying out all these various activities, businesses require money. Therefore, we call finance or we call money as the lifeblood of a business. Just as blood in a body is very crucial for the operations of different activities in the body, similarly, finance is required by the business for whatever it intends to do. The requirement of funds by the businesses to carry out the various activities is what we name as business finance. A business obviously cannot function unless adequate funds are made available to it. The initial capital contributed by the entrepreneur is not always sufficient, right? We start a business, we put in some money. But is that money always sufficient? Is that money going to be sufficient and adequate throughout the life of the business? No. Later on, at several stages, the business requires money. So how does the business get that sort of money? What are the sources of money? That is what we're going to talk about in this chapter. But before we do that, let us talk about the various kinds of funds that a business may require. Usually, the fund requirement or the capital requirements of a company or a business can be grouped under two categories: fixed capital requirements and working capital requirements. Fixed capital requirements are basically the funds required for investment in the fixed assets of the company. By fixed assets, we mean assets such as building, machinery, plant, furniture, etc. These are those assets which are going to benefit the business for a long duration of time. So the amount of money invested or to be invested in these assets is known as fixed capital, and it is very important for a business. While setting up a business, we need to invest a lot of money in the initial assets. Even in the later stages, we might require a machine upgradation, we might require new land, new furniture. So these investments basically help the company to grow in the future. They help the company or the business to set up initially. That's why fixed capital is very important. The second category is working capital requirement. Working capital requirement basically refers to the funds that are invested in the day-to-day running of the business. It could be the funds invested in the stock, it could be the amount needed to pay taxes, salaries, wages, rent, etc. So these sums of money required for day-to-day operations are called as working capital requirement of the business. Now that we know that a business requires funds of two types, fixed capital and working capital, now let us talk about where does a company or a business get these funds from. What are the sources of funds available to a business? Whether it is for short term, medium term or long term, what are the kind of funds that a business basically can look at? We can categorize the types of funds and then we can go into the sources of those funds. If we try to categorize, we can put these funds that a business requires into three broad categories. The first category is on the basis of periods or the duration of funds. On the basis of duration of funds, the funds can be either long term, medium term or short term. Long term funds or the long term sources are those sources of funds that provide us money for a period of 5 years or more. So funds that are used by the business for a period exceeding 5 years are called long-term sources of funds. These funds include sources such as shares, debentures, long-term borrowings and loans from financial institutions, etc. These are usually required for the acquisition of fixed assets such as equipment, plant, etc. Now, medium-term funds are those funds which are required for a period of more than 1 year but less than 5 years. So, funds for 1 to 5 years are called medium-term funds. They include borrowings from commercial banks, public deposits, lease financing, loans from financial institutions, etc. While short-term funds are funds which are required for a period of less than 1 year. These include sources such as trade credit, loan from commercial banks, commercial papers, etc. You will learn about these terms later on in this chapter. So, right now what we have done is we have categorized funds on the basis of period or duration, and on this basis there are 3 categories: long term funds for more than 5 years, medium term funds for 1 to 5 years, and short term funds for less than a year. The second basis for categorization is ownership. On the basis of ownership, sources or funds can be classified into owner's fund or borrowed fund. Owner's fund means funds that are provided by the owners of the company or a business. For a company, they can be shareholders. For other businesses, we can call them owners. So, funds provided by the owners are called owner's funds, while borrowed funds are the funds which are raised through loans or borrowings. The sources for raising borrowed funds can be from commercial banks, loans from other financial institutions, debentures, public deposits, etc. So, on the basis of ownership, funds can be either owner's fund or borrowed fund. Owner's funds are also known as equity, while borrowed funds are also known as debt. The third basis for categorization is whether the funds are generated from within the organization or from outside the organization. So, when the funds are generated from within the organization, it is known as internal sources of funds, while when the funds are obtained from outside the organization in the form of loans, debentures, etc., it is known as external sources of funds. The most prominent sources of internal funds are receiving money due from the receivables or using the retained earnings. So, now we have seen that funds can be categorized on various bases. Primarily, we have found 3 bases. The first basis is duration, the second basis is ownership, and the third basis is origin, whether the funds originate from within the organization or the funds originate from outside the organization. Each of these sources have their own unique characteristics. These characteristics must be properly understood so that the best available source of raising funds can be identified. Unless and until the business is aware of the pros and cons of all these sources of funds, it will not be in a position to decide wisely whether which fund is suitable in which situation. Because there is not a single best source of funds for all organizations and for all situations. Depending on the situation, proposed costs, associated risks, the business has to make a choice about which source it wants to use. So, now let us take a look at the merits, demerits and other details of some of these most common sources of funds for a business. Let us begin with retained earnings. Retained earnings are basically the amount of profits that a company or a business does not distribute. Usually, a company does not distribute all its earnings amongst the shareholders as dividends. A portion of the net earnings is usually retained by the business for use in the future. This retained profit is known as retained earnings. Since a company does not usually distribute all the earnings, in future when it requires funds, it can use these amount of retained earnings to fulfill its requirements. Retained earnings are a very good source of internal financing. They sometimes are also called as plowing back of profits. Basically, a company is plowing the profits back into the business. The profits came out of the business, it is giving them back to the business to be used in further growth and expansion. Retained earnings has its own merits and demerits. Sometimes people consider it to be the best source of finance because retained earnings is our own money, it's with us right there in the business. We do not have to go through a long procedure to issue anything. We do not have to pay a dividend or any interest on it. So people sometimes consider it to be the best and the single best source of fund, but that is not the case. We as students of this particular subject should know both sides of the source. Retained earnings are a good source, but they are not the best source. They would also have their own limitations. Let us talk about both its sides. When we talk about the merits, the first and the most common merit, the most important merit is that it is a permanent source of funds, which means that once we use retained earnings, we do not have to give it back to someone. Right? It's not like shares or debentures or loans that we have to repay. It is a permanent source of funds, right? Second, it does not involve any explicit cost. There is no explicit cost, neither in terms of flotation, neither in the form of interest or dividend. There is no clear explicit cost to be paid to anyone. Third, as the funds are generated internally, there is a greater degree of freedom and flexibility with the business. When you take a loan or borrow something from somebody, you kind of feel restrained. You feel controlled by them. But here, it is not the case. Since it is your own money, there is complete freedom and flexibility. You can do whatever you want. Fourth, it enhances the capacity of the business to absorb unexpected losses. So, when a company is saving money out of its profits, when it is retaining its earnings, it is basically preparing itself for any unexpected losses in the future. A company with good amount of retained earnings can absorb future losses more strongly. And finally, it may lead to increase the market price of the equity shares, because if a company is having a good amount of savings, it reflects a strong financial position to face future risks. This translates into a surge in the market price of the shares of the company. So these are the merits of retained earnings, but as I have already said, it has a downside also. The first thing is that if too much of earnings is getting retained, then there could be a dissatisfaction factor among the shareholders. They might get dissatisfied because the greater the amount of retained earnings is, the smaller or lower will be the amount of dividends that shareholders get. So if they keep on getting lower dividends year by year, they would start getting dissatisfied. So we cannot excessively plow back the profits. We cannot excessively retain the earnings. Then it is not a certain source of funds. It is an uncertain source of funds, because nobody can be certain about future profits. You cannot depend on profits or retained earnings forever, because sometimes some years may not give you profits. So it is an uncertain fluctuating source of fund. Third, the opportunity cost associated with these funds is usually ignored by the firms. This may lead to suboptimal use of funds. So when we talk about opportunity cost, what do we mean here? So see, when a firm is earning profits, but it is saving the profits instead of actually giving it to the shareholders or distributing it among the shareholders, what it is doing is that the share price of the company might not go up as much as it could have if it would have distributed funds in the form of dividends, because a company that keeps on issuing regular dividends, high dividends, usually creates a positive sentiment in the market and its share price goes up. Increased share price leads to increased shareholders' wealth or the increased wealth of owners. So ultimately, by not giving the profits as dividends, we are compromising or sacrificing on the increased shareholder wealth that could have been there if we would have given dividends. So basically, by keeping the profits, by retaining the earnings, we are giving up that increased shareholders' wealth, and that is the opportunity cost of retaining earnings, which we usually ignore, right? So this also has to be kept in mind, because retained earnings have this huge opportunity cost, right? So retained earnings can be a good source if they are used once in a while, but depending too much on retained earnings is not considered wise in the industry. After retained earnings, let us talk about another very common source of funds, which is the trade credit. Trade credit basically refers to the credit extended by one trader to another for the purchase of goods and services. So if I have a business and if I purchase goods from a supplier and if I get it on credit from that supplier, so basically that supplier is giving me trade credit. In accounting terms, we call those suppliers or the people as sundry creditors, or that amount as accounts payable. right? So trade credit is basically a short-term source which is used by a business for purchase of stuff like raw materials and other stock materials, etc. These are taken from one trader by the another trader. Terms of trade credit may vary from one industry to another, from one person to another. There is no set rule or standard for terms of trade credit. A firm may also offer different credit terms to different customers. So that can also be a case with it. Now talking about the merits of trade credit, number one, it is a very convenient and continuous source of funds. Because when we are dealing with a supplier or when we as a firm are dealing with customers, we are in continuous touch with them. We keep getting those, credit in a very regular manner. So it becomes a very continuous source of funds. You buy goods from the suppliers, you pay them later, and this is usually how things are done. So it is a very continuous source of fund or credit. Second, it is readily available, right? We don't have to make too much effort for it. A supplier with which a firm has good terms can easily provide credit to the firm. Third, it leads to promote the sales of an organization, because if a firm is getting trade credit, it is able to buy raw materials and other inventory. Using that, it can produce more, produce better, produce quickly, which helps to promote the sales of the organization. Fourth, if an organization wants to increase its inventory level to meet expected rise in sales volume. Let's say this is what happens during festive season, right? During festive season, firms usually want to keep a higher inventory. To keep a higher inventory, they need to purchase more. And that's when trade credit really comes handy. If they don't have money, they can resort to trade credit to support this increased inventory. Fifth, it does not create any charge on the assets of the firm. It is not like a big loan wherein we have to mortgage our assets or something. Right? So trade credit does not lead to any charge or any claim on the assets of the firm. So as a short-term source of fund, it is a very convenient and good source of fund for regular running of the business. But it too has certain limitations. Number one, since usually trade credit is easily and flexibly available, the firm might indulge in overtrading. It might just keep on buying because it is getting easy credit. It might just keep on overtrading, overpiling up its inventory, which is basically harmful for the business. Second, we can only get a limited amount of funds from trade credit. It is not a source for large amount of funds, right? Third, it generally is a costly source of funds when you compare it with other sources of raising money. After trade credit, let us talk about another very interesting source of funds, which is lease financing. Lease financing is basically a contractual agreement wherein one party, who is the owner of an asset, grants the other party the right to use the asset in return for a periodic payment. In other words, it is a renting of an asset for some specified period. So suppose I have a machinery and a person needs a machinery like that. That person, instead of buying the machinery, can get it on lease from me. I can give that machinery to that person on lease. What that means is that after the specified time period, let's say the person needed it for 3 years. After 3 years, he'll have to give it back. Till that time, he can keep on using it in return for a periodic payment, right? So it is a good way of, getting a machinery, getting a, big asset when we do not require it for a permanent purpose. Since we do not require it for a permanent purpose, hence instead of really going and buying and owning that asset, a firm can actually lease it from somebody in return for a periodic payment. The owner of the asset, in this case I, will be known as a lessor, while the party using the asset will be known as the lessee. The merits of this system are, number one, it enables the lessee to acquire the asset with a lower investment. As I've said, instead of buying that asset, especially when you do not need it for a very long period, you can just lease. It saves a lot of investment. Second, the documentation in this case is very simple, very easy. Third, the lease rentals paid by the lessee are deductible as expenses for computing their taxable profits. So it really helps in saving tax also. Fourth, it provides finance without diluting the ownership. So for the lessor, the asset still remains or belongs to the lessor. The lessor is still the owner of the asset. it does not dilute his or her ownership. He or she will get it back after that particular time period. So it is a good source of getting money for that person also. Fifth, the lease agreement does not affect the debt raising capacity of the enterprise, because it is not a loan, it is not a borrowing, not a big liability, so it does not affect the debt raising capacity of the enterprise. Finally, the risk of obsolescence is borne by the lessor. So even if there is a depreciation or an outdated technology during the time of the lease, the lessor is responsible for that. The lessor has to bear the expenses. This gives greater flexibility to the lessee to replace the asset. He is not bound for a very long period to keep on using an obsolete or an outdated asset or a technology. So these were the major merits of lease financing. This one also has its own limitations. Number one, it may impose certain restrictions on the use of the assets, since the lessor is still the owner. The lessee has not got the freedom to use the asset in whatever manner he or she wants. The lessor will impose certain restrictions. That really creates a constraint for the lessee. The normal business operations may be affected in case the lease is not renewed. So suppose you were depending upon that particular asset, the initial lease was for, let's say, 5 years. Now you are really used to that particular asset, your business is really used to that particular asset. You were hoping to get that contract renewed, and you were hoping to keep using that asset. But what if the lessor changes his or her mind and does not renew the lease agreement? This will affect the business operations of the lessee. Third, it may result in higher payout obligation in case the equipment is not found useful and the lessee opts for permanent termination of the lease agreement. So let's say the lessee leases in the asset, but later on finds that the asset is not really useful. This will really create a higher payout obligation. Finally, the lessee never becomes the owner of the asset. It deprives him of the residual value of the asset. He cannot sell the asset at the end of its life. It's not his asset. He is just using it, he is just renting it. Therefore, he cannot use the residual value of the asset. So today, in this particular lecture, after having understood what funds or finance means and what are different types of finances, we did talk about in detail for 3 sources of funds: retained earnings, trade credit, and lease financing. I hope you were able to understand the meaning of these sources and their pros and cons. In the coming lecture, we will talk about some more very crucial sources of funds for a business. This was it for today's class. Thank you.